Welcome to This Explainer. Today, we're diving right into the mechanics of arbitrage pricing theory, and we're going to break down exactly how it turns some pretty complex market dynamics into tangible, actionable opportunities. We'll be moving way beyond basic supply and demand to uncover the hidden macroeconomic levers that dictate an asset's true value.
So, what if I told you that you could guarantee a profit in the stock market using absolutely none of your own money and taking on zero extra risk? It sounds a little like magic, right? But that provocative idea is the exact driving force behind the concept of arbitrage. Arbitrage is essentially the realization of a positive expected return from overvalued or undervalued securities. And as we're going to see, it isn't magic at all. It's actually just highly disciplined mathematics based entirely on market inefficiencies.
Here is how we're going to break this down. First, the foundation. Then, the multi-factor model. Third, how arbitrage actually works. Fourth, comparing APT and CAPM. Fifth, identifying the hidden factors. And finally, taking APT global.
Let's start with Section 1, the foundation.
Before we can go out and exploit mispricings, we really need to understand how the market is supposed to price assets when it's functioning perfectly. And it all comes down to the law of one price. The idea here is that the market inherently wants to be in absolute balance. Proposed by economist Stephen Ross back in 1976, arbitrage pricing theory, or APT, relies heavily on this law. It basically says that in an equilibrium market, rational investors are going to ruthlessly implement arbitrage until that equilibrium price is reached. Once every single arbitrage opportunity is exhausted, well, then you have a crystal clear picture of an asset's true value.
Moving right along to Section 2, the multi-factor model.
Think of an asset like a machine with a whole bunch of moving parts. In APT, those specific levers are macroeconomic variables. The model says returns are built on a base constant for the asset, plus a series of systematic macroeconomic factors. You can think of a factor's beta as a sort of volume dial, measuring exactly how sensitive the asset is to that specific economic shock. And finally, you have your idiosyncratic random shock, which is basically just the unpredictable noise that is totally uncorrelated with other assets. The big takeaway here is that an asset's return is never just one random number. It's driven by these specific stackable building blocks.
And when you write it all out, it actually maps perfectly as a linear equation. Your expected return is simply the risk-free rate plus the sum of each factor's risk premium multiplied by the asset's sensitivity to it. Now, this does assume perfect competition in the market, and a really important mathematical quirk here is that the total number of factors can literally never surpass the total number of assets, otherwise the math just completely falls apart.
All right, Section 3, how arbitrage actually works.
Let's step into the shoes of our market mechanic and look at the actual blueprint of a trade when the pricing machine outputs the wrong number. How do we fix a mispricing without taking on any extra risk? Well, the arbitrager basically builds a synthetic portfolio, a financial clone, if you will. Under APT, an asset is mispriced if its real-world price diverges from the price predicted by our multi-factor formula. To exploit that, you find a group of correctly priced assets and mix them together so your new clone portfolio has the exact same beta per factor as the mispriced asset. They become risk twins.
Let's play this out. Say an asset's price today is just way too low. Today, you would short sell your perfectly priced synthetic portfolio and use the cash you just generated to buy the cheap asset. Your net macro risk is zero because remember, their risk profiles are identical. Then, at the end of the period, prices reach equilibrium. You sell the asset, buy back your synthetic portfolio, and you pocket a mathematically guaranteed difference.
But what if the asset is too expensive? You literally just flip the playbook. Today, you short the overpriced asset, use that cash to buy your synthetic clone, and wait. When prices eventually converge down the line, you reverse the trade. Let's recap that because it's absolutely crucial. Zero net investment, zero macro risk, guaranteed profit.
Which brings us to Section 4, comparing APT and CAPM.
Before APT came along, the Capital Asset Pricing Model, or CAPM, totally ruled the finance world. So how do they compare? Well, CAPM is a demand-side model that essentially lumps all risk into one giant bucket called the market portfolio. APT, on the other hand, is a supply-side, multi-factor model that acknowledges every stock reacts completely differently to different economic shocks. Because APT lets each investor hold a unique portfolio tailored to a specific array of betas, it's way more flexible. But, and this is kind of funny, because picking the exact APT factors can be somewhat ambiguous in practice, the much simpler CAPM model has actually occasionally outperformed it in empirical testing.
Let's look at Section 5, Identifying the Hidden Factors.
So, what exactly are these mysterious levers pulling on our asset's price? The funny thing is, APT itself doesn't explicitly name the factors. It leaves it as an empirical puzzle for us to figure out. But academics Chen, Roll, and Ross did the heavy lifting for us here, and they identified 4 significant factors. And the operative word for all of them is surprises. We are talking about surprises in inflation, surprises in gross national product, sudden shifts in investor confidence, and unexpected shifts in the yield curve. You see, if the market already expects it, it's already priced in. Only the totally unexpected shocks actually move the needle and require a risk premium.
Here's the catch, though. True macro factors are usually only reported at really low frequencies, like maybe once a month. Waiting a whole month for a GNP report isn't exactly useful for a fast-moving arbitrager. So in the real world, traders use real-time market indices as proxies. They act as stand-ins for those macroeconomic forces. We're talking short-term interest rates, the spread between long and short-term rates, massive indices like the S&P 500, or even the real-time spot prices of oil, gold, and currencies.
And finally, Section 6, Taking APT Global.
Because obviously, capital doesn't stop at the shoreline. Our pricing models shouldn't either. Tracing its evolution, we see APT adapt incredibly fast to integrated international markets. Ross proposed it in 1976, and by 1983, Solnick had already extended it to handle international exchange rates, setting the stage for FAMA and French in 1995.
FAMA and French really shook things up. They demonstrated that assets in integrated global markets could actually be priced consistently using a common universal set of factors. They zoomed out from abstract macro shocks and explained returns using 3 specific benchmarks: overall market risk, the size of the company, and the value of the company. It essentially proved that across all these different international markets, you could use these exact same 3 factors as a universal baseline for expected returns.
And that brings us to International Arbitrage Pricing Theory, or IAPT. Validated by empirical test in 2012, this proves that foreign exchange risk isn't just background noise. It is a fundamental lever in international asset pricing. Solnick's framework actually broke individual investor returns down to explicitly show that total foreign exchange risk consists of the immediate exchange rate risk plus residual market factors. Basically, your base currency fluctuations have a direct, measurable effect on an asset's risk premium. You simply cannot ignore it when pricing assets on a global scale.
Which leaves us with a pretty fascinating question. As global markets become increasingly hyper-efficient and algorithms enforce the law of one price almost instantly, where will the next risk-free profit even come from? Arbitrage relies entirely on mispricings, but the very act of executing the trade mathematically forces the market right back into equilibrium. As technology makes identifying these imbalances totally instantaneous, the window for profit shrinks from days down to actual milliseconds. So what really happens when the ultimate financial machine finally runs perfectly? That is definitely something to think about. Thanks for joining me on this explainer, and keep questioning the mechanics behind the numbers.